Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of November 10th, 2024. And in this week's episode, it's just myself, Sprocket888, and I want to take a little bit to recap some recent trades that I had laid out and said I was going to take. Pretty much almost all of them have now concluded, and I want to just do a recap of, how they played out and what the mechanics of it were. And of course, I'll bring up the ever popular Flappy Bird chart on each of these. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So subscribe to us, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. In this week, I want to go back and recap how a couple of recent trades that I had kind of talked about taking have panned out. They have all since closed, mostly. There's about 6 of them that I want to run through. They're a mixture. Some of them are earnings trades, and others are what I call the daily theta trades, where I basically try to get a delta neutral thing and just kind of let the time premium burn off. So I sell the time premium. I'm looking for the stock not to move too much in the upside or too much in the downside direction, and just collect that premium theta decay each day. And so it's a mixture of those. The 6 names that I'm going to take us through today are Atlassian, ticker TEAM, Intel, ticker INTC, Ford, ticker F, Snapchat, ticker SNAP, Meta, META, and lastly, Discover Financial Services, DFS. And I'll go ahead and put a link to the previous episodes up above as well as in the description down below. These were kind of laid out recently. It was all about kind of trying to find some trades in the past couple of episodes. I put out a couple of things that I was looking at. I ended up taking some of these trades. So I'm going to run through each of these trades that I ended up taking. We'll go ahead and take a look at the chart for the trade, means the table of, how much premium did I collect? When did I collect it? How did I close it out? How much did I pay to close it out? And we'll look at some of the price action, at least as it passes through the strikes on the Flappy Bird chart. Now, first up, we have Atlassian. Now, Atlassian was one of the earnings trades that I went out there to play. Now, Atlassian had earnings and had really extended volatility. Actually, all of these trades I'm going to talk about had extended volatility. And that's pretty much one of the prerequisites to my premium selling trade is I need that volatility to be extra on the extended side. So Atlassian, ticker TEAM, went into earnings, and this is one that got a little bit tight on the call side. And so basically what happened is I went into this week of expiration. So I opened this on October 28th. The expiration was that Friday, November 1st, and I went and did about a 20 delta strangle, which means I went about a 20 delta put and a 20 delta call and sold both of those, which means I'm looking for it to stay within about 1 standard deviation move of the expected move. So I collected $4.35 for each of these strangles. I went ahead and sold 2 of them. So I collected $870 in premium. Now, Atlassian had absolutely blockbuster earnings, and they skyrocketed up. In fact, they went deep into the money right after the earnings announcement. I felt that it was really, really overextended and was looking kind of for a pullback on Atlassian. So I went ahead and held that thing all the way into the Friday of expiration, kind of hoping that this was going to drop down below that 220 call as it went way past the 220 call. Unfortunately, it did not come back in under 220. And on Friday, it was declining throughout the day after earnings, but it never came down deep enough to close out. And I didn't really want to close this thing up for a loss. So I went ahead and I took assignment. Now, whenever you play these trades of naked put, naked call, you really have to be okay with assignment because while it doesn't happen often, it is a feasible and potential outcome. Now, going into that Friday, I thought I might roll the call side. But with such a move in Atlassian, I wasn't really sure if it would have a real strong reversion to the mean. And so I didn't really kind of want to roll the call for fear that perhaps if it didn't get that strong reversion to a mean, then I might end up becoming deeper and deeper into it. And so my plan was actually to take assignment on the shares, which in effect, I didn't have the shares, so I had to buy them at market price to fulfill the assignment. So I was going to be short 200 shares of Atlassian. And what I intended to do was on Monday, go ahead and sell a put that was basically at the 220 put. So it would have been close to at the money. And it would have kind of been a covered put. It's very similar to a covered call, except it's in the other direction. However, Monday came around and the stock was under a lot of pressure, and it was really coming down. Actually, opened below 220. I wasn't quick on the trigger enough, and so I ended up closing out at 220.29, so 220 and 29 cents. So effectively, because I was assigned at 220 and then sold it, or then closed it out for 220 and 29 cents, I had a cost of 29 cents a contract to close. So if you look at the chart there, I went ahead and collected about $812. So that's the 870 minus the $58 it cost me to close, or that 29 cents. And I had about $4,000 in buying power taken up. So my return on capital was roughly 20% for a few days trade. So I opened it on the 28th, closed it out on the following Monday, the 4th. And turns out that was a pretty good idea because if we take a look at the Flappy Bird chart for this, you can see that right here, this big green bar, this was the earnings announcement, and that earnings announcement just skyrocketed up into the call. I mean, we reached there after earnings 234. So, I mean, that was $14 in the money. And this big candle here was, so this end of the red box is where I got assigned. And then you can see we kind of dipped down below that 220. This following Monday was in this candle right here that I was able to close out. So I could have held on and a few days go by, another day goes by, and I could have, turned it for even more of a profit. However, it was already kind of a really strong upward momentum, small trace back. I really wanted to kind of get out, recycle it. It was still going to be green, almost a 20% return on capital in just a few days' time. And then boom, off to the races. So it's a really good thing that I closed this thing out because it kind of came back down, touched around this 215 to 218 level, and then it was off to the races again. Now, the next trade is Intel. And Intel was not an earnings trade, but rather it was a daily theta burn trade. And when I say daily theta burn, I'm basically looking for something that had extended volatility. It actually was an earnings trade, but it wasn't an earnings trade in the sense that I was going to close it out the week of earnings. So Intel is one of these stocks that I really feel I'd be okay owning at this particular share. It has been absolutely hammered and beaten down year after year after year. It's basically kind of on death's doorstep. If you look at a lot of the news, a lot of the articles, totally left behind in AI. And so I was okay kind of owning some of these shares of Intel. Now, I went ahead and put this trade on around earnings because volatility was extra extended. I went ahead and played this one kind of tighter. I think it ended up being about a 25 delta. I know this says a 20 delta, but I think if I recall right, it actually ended up being more like a 25 delta. I only did this on the put side because I am relatively bullish on the stock, and I didn't really know what they were going to kind of announce as earnings, whether or not it was going to plummet and I would get assignment on it, or if things were going to be good and we were going to kind of take off. Either way, I went out to the monthly expiration to kind of get that more of the theta decay. Again, I was okay with assignment. So I opened this one up on October 28th. I actually still have this one open, although it is well above my strike. So I'll show you that in the Flappy Bird chart, but I collected $1.08 per contract. I went ahead and did 15 of these contracts. So if I was to be assigned, I would be assigned 1,500 shares of Intel. I was okay with that. This was about a $3,700 buying power. I do intend to kind of hold these into expiration so they go to zero. So I am expecting either assignment or 100% profit on this. So right now, there's about another week left, and it is well away from my strike, about $5 above my strike currently. And so I'm kind of expecting this to close out at 100% profit and not take assignment on it. That'll roughly give me about a 44% return on capital as I collected a little over $1,600 for those 15 contracts. And if we go ahead and take a look at the Flappy Bird chart here for that, you can see this red box down here is my short put. That was a $21 put. And you can see that the earnings came out right here. It kind of thrashed around in this real big, this green candle with this huge wick on the top and the bottom where it was just kind of all over the place. But it kind of settled down and then kind of took off to the races a little bit here. So currently trading around $26 a share. I am short here down at 21. Like I said, there's only about a week left on this. So, we'll see how it pans out, but it is very unlikely, in my opinion, to kind of come down here and breach my strike. So I likely will go ahead and grab 100% of this. Next trade up is Ford. Now, Ford is another one that I went into. I went into it before earnings, but again, I went into this one more as a daily theta trade. So I did not take the expiration the week of earnings. I went out to the next monthly expiration, but I entered it on the elevated volatility ahead of earnings. Again, this was about a 20 delta strike that I went in on. So on October 28th, I went ahead and sold 20 short puts of Ford. The strike was $10.50. I collected 27 cents per contract, so a net of $540. That was about $2,800 in buying power. And again, this is one of the ones that I'm kind of okay to own. Ford, in my opinion, is doing pretty decent when it comes to the non-Tesla EVs. I know they've gotten a lot of bad press. They are kind of cutting production, but I really feel they're not giving up on the EVs. And so I really kind of do like the way that Ford is positioned. So I'm okay to hold these shares, especially around the strike price. So again, this is one that I actually still have open. I have not closed it out. It's got about another week left. It's not near as far into the money as the previous one that I mentioned with Intel. So this is one where I might actually, depending on where the volatility is, because volatility really didn't deflate out of this one very much. And so I will strongly consider rolling this. So same strike, just going out another month to collect more premium, because again, I'm looking for that daily theta burn and I am okay at assignment at $10.50. And so if we look at this on the Flappy Bird chart, you'll see what I'm talking about, where they had their earnings announcement. Here it's the green box towards the beginning here. It's this big kind of red cliff. We actually breached the strike. I went in the money here on Ford. We have since kind of come out of it, but we're only trading a little bit less than where it was going into earnings at around $11. And so it's only 50% or 50 cents out of the money. So again, depending on volatility, this is one where I likely might roll this as it is just kind of collecting premium. So as long as the volatility is still there, it probably will be worth my time to go ahead and roll that as it doesn't take that much buying power and the premium could be relatively lucrative. Next one is Snap. Now, this was purely an earnings trade. So I opened this one on October 25th. Heading into earnings, it was going to expire that Friday, November the 1st. I ended up closing it out right after earnings on October 30th. So I went and did about a 20 delta strangle on this, collected 92 cents a contract. I went ahead and did 15 contracts here because at 950 put and 13 call, there really wasn't a ton of buying power. So I was able to go ahead and sell 15 of these contracts using about 3,000 in buying power, but netted 1,380 in premium. And then right after earnings, volatility absolutely evaporated out of this thing. It stayed between the strangle strikes, and I was able to close this thing out for 15 cents a contract, so about $225 to close that out, netting me a $1,155 in total premium against that $3,000 in buying power. Was about a 39% return on capital for a real quick kind of 5-day trade there. So I actually opened it up this week before earnings. For the week of earnings expiration, was able to close it out right after earnings. If we take a look at the Flappy Bird chart, I mean, this really was a textbook. You can see this red box is when I opened the trade, when the trade was set to expire. Earnings are when the volatility, this big green candle, kind of went up there. I ended up closing out while it was kind of in this 1250 range. There was plenty of volatility just completely gone. I actually could have carried this one out to expiration, but again, I had already collected a really high percentage of my premium. And I didn't really want to risk assignment once I had already collected so much premium. So I closed that one out for that 15 cents a contract. And again, 39% return in just a matter of days. I was really, really happy with this one as it was a textbook volatility collapse. Next was another earnings trade on Meta. Again, this was an earnings trade, so I put it for the week of earnings expiration, November 1st. I entered this one on October 25th. I went ahead and did about a 20 delta strangle. Again, that's about a 1 standard deviation move. That's pretty much where I start with all of my strangles. I was only did one of these contracts because it was relatively large buying power, as this was, a $600 underlying stock. And so it took about $6,000 in buying power. The volatility was really elevated. I collected $14.70 for that strangle. And again, it was just a textbook's earnings trade where it stayed between the strikes. 535 and 625 were my strangle strikes. And right after earnings, volatility absolutely collapsed. I was able to close it out the day after earnings for 31 cents. So I sold 1470 and closed it out for 31 cents. Just absolutely textbook perfect. Worked out wonderfully for me. If we take a look at the Flappy Bird chart, actually before I do, $31 to close that thing out, netted $1,439, which is a 24% return on capital in really like less than a week. And so the Flappy Bird chart, just to kind of show you right here, this is where this kind of earnings kind of came out, where we kind of rocketed up, and then, rocketing up kind of came out in anticipation of earnings. Earnings came out, it kind of pulled back. Really, this thing didn't end up going anywhere. Here's the Flappy Bird chart. Hey, diddle diddle, right down the middle. That's about as wonderful as a setup as you can actually have. All right, now the very last one I want to talk about is Discover Financial Services. Now, this is one that's not going super well actually at the moment. I'm still pretty okay with it, and I'll kind of talk through it. This one actually is still open. It is in the money, and it is in the money on the call side. So not ideal, and I did a few different things because this was a combination of an actual earnings trade for the week of earnings and a daily theta burn because I really liked the elevated volatility. So I went ahead and tried to play the week of earnings as well as extend out another play that went to the next monthly expiration. And so on October 14th, I sold the earnings trade piece of this, which was the 135 put, 155 call strangle. I did 2 of those at $3.30. Those were the week of earnings expiration. Now, those I ended up closing out on October 17th, right after earnings for 36 cents. So that was $6.60 here and then $72 to close. I also opened up a monthly expiration of 130, 165. So both of these were about a 20 delta strikes, right? But because the week of earnings was closer, the 20 delta didn't get you as far apart as the one that went out a month. So when I went out the month, I sold one of these at 569, collected that. Now, on 10/17, I went ahead and sold another monthly. So this was kind of right after earnings. Volatility really didn't contract that much. So I went ahead and put a second trade on for that monthly expiration. So I did 2 the week of earnings, plus I put 1 longer term one on. Earnings came, closed out those 2 positions on earnings, and then I went ahead and extended another play to the next monthly. So I ended up with 2 monthlies and 2 week of earnings, a little bit staggered by a day or so. And then I most recently on November 6th, closed out the monthly puts, only the puts. And I'll show you in the Flappy Bird chart, basically this thing took off after the election. And so it is actually in the money on the call side, and I am likely going to face assignment in the next week-ish if it doesn't kind of return. However, I'm kind of looking for the price action to give more of a reversion to the mean and see what kind of happens with this. So I technically still have 2 calls out there. One of the calls at 170 and the other call at 165. And so it is kind of in the money. It's taking up about $4,100 in buying power. So as it stands right now, if those were to be able to close out of the money, which is not where they stand today, this trade or this sequence of trades would net me about 16, 18 in capital for about $4,100 in buying power or about a 39% return on capital. I'm going to go ahead and pull up the Flappy Bird chart and show you what I'm talking about. So if we look at the Flappy Bird chart, we got two red boxes. This first red box is my closer earnings strangle. So this is the one you can see it's stuck right here in the middle. Volatility kind of collapsed for that week. Now, not a lot of volatility came out of the longer term trade, which is why I went ahead and put another one on. So I closed out the two that were part of this box here. Then I added another one. So I actually have two trades that are reflective of these bigger red boxes. The U.S. elections happened, and there was just massive markets just took off, especially regional banks and small financials, which is where Discover kind of fits in. So just massive jump here from around the 150 mark, 155 mark, all the way up to 180 something, mid 80s. And you can see it's kind of been falling back off. So this red box is where this trade ends. I'm looking to kind of hang on to this as we get closer to see if we kind of dip below here. And it would be interesting if we, of course, dip below here. I'll close this thing out. Most of that premium, I'll be able to recoup that, and I'll be sitting wonderfully for the earnings trade. If we don't quite come back down here, what I might consider doing, if volatility is still there, is rolling the call side and then also selling a put, probably up here in this 148 to 155 range, because likely if we get a retracement, there's going to be resistance here. So you can see on the price action, we had kind of previous highs here. If I zoom out, we've been kind of climbing. And so there is very likely kind of coming back closer to this range for a retest before kind of continuing higher. But we'll really see kind of how that trade pans out. So of all of the six that I went through today, this is the one that is probably in the worst shape as far as collecting a large profit. Again, right as it stands now, I am still green on this trade, but really barely. If you net all the premiums that I've collected and kind of add them on. So looking for just a little bit more reversion to the mean before I close this one out. And that brings us to the end of this week's episode. I really have been laying out trades, and I wanted to take a moment just to recap how a lot of these panned out. And 6 trades, 5 of them winners. The last one kind of might end up being a winner, but it really just kind of goes to highlight that this probabilistic premium selling strategy that I embark on really does work out. You can go to thetagang.com/sprocket888. You can see a lot of my historical stuff. I know I talk with a lot of people and they really doubt it. They're like, oh yeah, you can't have that high a win percentage. But really when you sell this elevated volatility, the odds are truly in your favor probabilistically. And so as long as you kind of manage your losers and you pick out the stocks where, if assignment, you're okay with assignment, you believe in the underlying company, lining up with the price action, I really think you can tilt these things into not quite an automatic, cash flow in a monthly sense, but you can really turn it around so that a high percentage of your trades are winners. Sure, they're not home run winners. You're not hitting the spectacular grand slam out into the park where you're bringing all the runners and all that stuff in. This is a real boring get on base, and eventually you'll kind of push all the runners around, and you'll just slowly rack up the runs. And in the end of the game, that's really what matters, is the number of runs that you can pull in, not so much how spectacular was the hit. Well, the year is winding down. The U.S. election is over, so a lot of the volatility has kind of come out of the market. Markets have really been on a tear. I'm kind of expecting probably to watch a lot of these names, because the amount of upside that these things have moved, I'm really going to look for a reversion to a mean, maybe to get a little bit more heightened volatility and see what type of premiums are out there to sell. That really is the strategy that I try to employ the most. And I'll be on the lookout for more of these premium selling plays. So stay tuned. Good luck out there. And remember, think outside the block.